Okay, we're going to continue on with problem 16.5 in our book, and we're talking about nonprofit accounting transactions. So we're going to continue on with number 6. We have a lot in building estimated the fair market value of $850,000 were donated to the Institute on the condition that they be sold and the proceeds be used for Program D, which serves physically and mentally handicapped babies and children. So what we are going to do, actually, again, is pretty straightforward. We're going to record the fair market value of that donation of $850,000. So we're going to record the building asset of $850,000. We're going to have our temporarily restricted contribution for $850,000. Okay, because that's restricted for a specific program, and the funds can be used for that particular program. And that's all that's to that entry. So at number 7, then we turn around and we sold that building for its fair market value of $850,000. So again, straightforward, and $850,000. Our resale building is going to be credited for $850,000, and we have the cash, and the building is off our books. Next, let's look at number 8 there. And we have investment earnings were accrued and received as follows. We have earnings on unrestricted investments of $40,000, which was accrued, which means we didn't receive the cash. Restricted earnings on program restricted investments, $60,000 accrued. So those are designated. So they're probably from either those are from temporary restricted funds. We have restricted earnings on endowment investments of $65,000 from our item that we had done in the first part of this problem. And we had unrestricted earnings on investments that were restricted for plant purposes of $35,000. So what we're going to have here is we have a total of $100,000 accrued interest receivable. So we have an interest receivable in the books. Again, nonprofit accounting is following an accrual type of basis. So we're recording these entries even though we haven't actually received the cash in some cases. Our cash earnings were $100,000 also. Okay, so that's going to increase our cash. Our unrestricted interest income. So we're going to have interest income that was unrestricted for $75,000. Okay, and that is made up of our unrestricted earnings on investments for plant purposes and our unrestricted investments that were accrued. And then finally, our temporarily restricted are going to be the balance of those, which total $125,000. So even though the endowment, just note there that even though the endowment investment is permanently restricted, the interest from that would be temporarily restricted to the purpose of which the endowment is for. So in this case, the endowment earns $65,000, which would be used for assisting handicapped people as was set up, as the endowment was set up in transaction number 1. So it's not permanently, that interest is not permanently restricted, it's temporarily restricted and can be used for that designated purpose. That's the whole purpose of having the endowment. Okay, next we had a fundraiser. Quite often has. Of course, nonprofits do a lot of these. We have a fundraising bazaar and banquet. All $300,000 of gross receipts were unrestricted. We had cost of food, gifts, kitchen help, and waiters totaled $60,000. Cost would have been higher, but the hotel waived its normal charge of $10,000, and we had local supermarkets donate food and merchandise valued at $7,500. So we're going to have a couple transactions to record here. And again, it's important that we record all of these, not just the direct expenses that we paid cash for. So first of all, we're going to record the cash proceeds from the event, $300,000. Okay, and so we're going to have the proceeds. We're going to credit that for our unrestricted contributions for our special events. That's a revenue account. Then we're going to have our direct expenses for our special event. And those direct expenses that we paid are those $60,000 for the kitchen help, food, gifts, etc. And then we had cash spent of $60,000. Easy enough. Then finally, we have to record the contributed services. Okay, so donated or contributed services, I often call them contributed services, are the value of the items that were given, and that's a donation. So not only is it revenue for you and an expense of having the event, even though it's non-cash, but it's also something that we will need to give receipts to. So when people donate that, they often write off those. So we can donate. We can write a receipt for that, and they may or may not deduct it from taxes, depending on what it is. Okay, special events direct cost. So the value of those was total at $17,500. Our donated facility usage was $10,000, and we had $7,500 of merchandise donated. Whoops, not 75,000, 7,500. Okay. So there we have it. That's how we would record our event. Again, we need to record those donated services, not just the actual cash that we paid, but also the total value of the donation, which includes those donated services, which we're going to move on to on number 10. We have a similar situation, only for direct services to our clientele. So we have a doctor that he provided $30,000 worth of for his services, and we also had another a psychologist who donated $15,000 of his time, and they spread those times on 30% on program A, 20% on program B, 25% on C and D, respectively. So the total value of our donated services are going to be the $30,000 for the doctor and the $15,000 for the psychologist, so we have $45,000. Again, you noted that the donations were valued at conservative methods, so conservative value for it. So they're not, you're not going to have a grocery store checker charging doctor's fees, whatever. So it's got to be reasonable and customary for that type of work. Okay, and also conversely, if there's a doctor that's coming in and donating its time working, the food stand or whatever, where the value is actually on the work performed, not his normal duty. So if he's doing clerical, he comes in and does clerical work, that would be valued at a clerical work salary, not at the full doctor value and charge per hour. So we're breaking that out. We're going to take that total $45,000 and 30% of it, or $13,500, goes to program A. We have 9,000 of it, 20% going to program B. I'm getting zero happy here. We have 11,250 that are going to programs C and D. So that's how we're recording the investment, or those donated services. Okay, and our final example in this problem is we have a family that donated a lot and building, also donated land and a small building adjacent to our offices for use as an infant nursery and playground. The land and building are conservatively appraised at $100,000 for the land, $250,000 for the building. Notice we're doing those separately. But we have a 6% $50,000 mortgage note payable on the building, which the Institute assumed. One of the things, if you are involved in a nonprofit organization, you will find that you have lots of people will try to donate things to you. Most of the time they have good intentions. A lot of times, sometimes though, you have stuff they're trying to get rid of. So always be careful. Make sure there's not groundwater contamination or etc. Make sure that it's worth it. Okay, or a lot of times computers. Sometimes When I worked at school systems, we had computers being donated that were ancient and really didn't do us any good. So anyway, should have a policy on that, and be careful of what. Don't accept just anything. Make sure it's going to benefit your organization. So we're going to record this like normal. We're going to have $100,000 fair market value of land, and we're going to record the $250,000 fair market value of our building. We have a note payable that we're assuming of $50,000. So we're going to have to record that note payable, and we'll be having principal and interest payments like we did up above as we go along. And then we have our unrestricted contribution will be for the net amount of that. So it's going to be for $300,000, not for the full $350,000. So it's only for, because we're assuming that $50,000 note, we're not going to give them a full $350,000 credit for that donation. It's only going to be for $300,000. So it's still obviously a good deal for the institute, but we do have to properly account for that. And that is it for problem 13-5. This is again some typical entries for nonprofits. One thing again you'll see is that they don't differ that much from for-profit. It's mostly in the restrictions and how we account for the restrictions: temporarily restricted, permanently restricted, or unrestricted.